All right, we have to stick with the time. So today the focus is about leverage. In my 30 years of doing taxes, I have encountered a lot of very smart investors, and I was able to convince them that leverage is your friend. It's not your enemy. Contrary to a lot of, especially we new immigrants, we always think we can buy with cash. We are the king, right? So this seminar is going to focus on why leverage from a tax standpoint of view is a must for real estate investment, even in the high interest environment. So today we have two guest speakers besides me. Let's first give it to Kathy. Kathy is one of the best loan officers, especially commercial loan officers I have met in my 30 years of practice. So Kathy, it's to you.
All right. Well, thanks, Justin. And you are the best accountant I've ever met. So it's my honor to be able to join at this in this webinar. So I am the SVP Loans or Chief Lender of American Metro Bank. The title is pretty self-explanatory. I oversee the lending side of the bank. We keep our loans in-house, and multifamily properties are a large part of the bank's portfolio. We also have a niche in construction and rehab financing. So the bank I work with is a more of a boutique bank, which means that you are more than a number to us. So we spend time to know you and know your financials well. Personally, I'm originally from Shanghai, just like Justine, and I grew up in Chicago. So I know the city pretty well, which gives me a good market knowledge. So when I see a property address, I already know, have an idea of the risk profile or the return of this property. So when we evaluate each loan at the bank, we of course do our due diligence. We are governed by the FDIC and have to follow their guidelines. However, unlike some big banks who just look at the numbers, we exercise good common sense and market knowledge to assess the risk level of each loan and figure out quickly whether that would be a good investment for us. So that's something.
Yeah, exactly. I can echo on the common sense. I think that's what really strikes me as your strengths. Very much common sense handshake kind of underwriting, you know. And we really need that in this world. Agreed?
Exactly.
We need it. Yeah, you really look at the borrower and look at the property from a very wholesome, perspective. Okay.
Yeah.
Sushil, which is our own real estate investment advisor on our team. Can we hear you now, Sushil, or no? Okay, we can't hear you. Sushil, it's okay. You will be silent today. I will do your part. I will wear two hats, Sushil hat and Justine hat. It's okay. Technical difficulties happens every day. All right. Just a few more minutes about who we are. Everyone knows me as an accountant. And I always say we're not just an accountant. We provide tax-efficient wealth accumulation and protection solutions, and even help you execute them. And that's why I have two other arms, the real estate arm and the insurance arm, to help my clients to execute those tax-efficient strategies. That will be it. Okay, let's get to the meat of the presentation. Why leverage in real estate? I can give you one very good example. Maybe that client is even in the webinar listening, so maybe it's you, but I'm not going to say your name, okay? Probably 4 years ago, a very successful couple came to me talking about how they can really become, really build a real estate portfolio. I looked at what they have. I said, all you got to do is cash out and buy more, because they paid all their real estate investment, in cash. I remember at that time they had 3 properties. And if you remember, Kathy, right, 4 years ago, what's the interest rate?
Oh my gosh, if we can go back in time.
Oh my God, yeah. So they actually took my advice, and now I think they have close to 12 properties just using leverage. So I'm going to share the next slide. The reason I, as an accountant, encourage people to go leverage, the first thing is it improves tax equivalent yield. So tax equivalent yield in our jargon is TEY, right? So whenever you compare to investment, you never just compare the nominal return, because there's Uncle Sam there, right? Is he omnipresent? No. He's dirty hands into all your pockets. So when we compare investment, we really have to compare what's the tax equivalent yield. And we have an excellent example that's prepared by Sushil, a real example with real numbers to show you how drastically leverage can help you improve your tax equivalent yield. The main reason here, I'm going to be steal your thunder, Sushil, is because all the interest expense is tax deductible. So in many ways, I tell people, if you borrow at 7%, you think it's really high, right? But if your tax bracket is 50%, you're actually borrowing at 3.5%. 3.5 is good, even at 7. In those days, it was 4%, right? So you're borrowing at 2%.
I'm going to steal that, Justin. I'm going to tell my clients.
Yeah, because that's your tax bracket. Sure. Yeah, if your tax bracket is not 50, let's say it's 40, still it's significant, right? Just like every one of my clients almost every one of them invested the treasury bill last year because what? It's 5%, right? Kathy, you probably did some too.
Yeah.
And when the tax time comes, they're to give back Uncle Sam the 2.5. That's sad, right? So the joke is interest is the worst kind of investment income. It's a great place to park your money. It's better than checking account, right? But it's not really an investment because it's never really, it's never going to pass the inflation, the tax equivalent yield, right? And the second one, I think everyone already know, when you leverage, you can enjoy a much bigger portfolio, just like the example I told you of my clients, right? How they can, I mean, I told them the tip at the best timing possible, but sometimes it's not just timing. I always believe, what's the word? Never time, right? It's the time you have in the market, right? That's how they say it, never time the market, same thing. That's why we're also talking about, even in a high interest rate, why leverage is important, right? And another thing is how you can accumulate generational wealth through real estate investment, through leverage. So those are the three biggest points. So I'm going to give it to Sushil, talk about how leverage can improve your tax equivalent yield. Sushil, I think you can talk now. Try.
Can you guys hear me now?
Yes, maybe a little bit self-introduction too.
Awesome. That's wonderful. Apologize for the technical glitch here, but somehow I figured this out. So I've been a real estate professional in Chicago for over 10 years now. I have a license. I'm a licensed broker here in the state of Illinois, and I focus in the city of Chicago. I work for Joe Agency full time as a real estate investment advisor. My job pretty much is to find that one investment property that not only gives you an amazing return, but also is tax efficient. So our focus, we are a tax firm, so our focus is always finding properties that are not only generating good returns, but they're very tax efficient. And that led me to bring this property to you guys. Amazing 6-unit multifamily in the Ukrainian village. Again, it's a booming neighborhood. It's grown more than the other neighborhoods of Chicago, I would say, in the last 5 years.
So it's very hip, right? Cassie knows it's a hip.
It is. I would say it is like how West Loop was 10, 12 years ago. Nobody was trying to go there, and now it is the hottest neighborhood. So this is just slightly northwest to West Loop. So 5 miles from our office on Michigan Avenue, so not too far. Got amazing public transportation, very lively neighborhood. So people love this. And that's the reason these properties are now selling like hotcakes. It's listed for 1.59 million, fully rented. It's generating 155,400 in gross rent. And after all the expenses, your net income comes to 111,795.
Okay, maybe you can explain to us what expenses did you deduct when you arrived to the 111?
Sure. So the number one is the property tax, which is the number one expense or the highest expense. We've deducted insurance, we've deducted utility bills. So in this case, the tenant pays for electric, heat, except for water. Everything else is paid by the tenant. So we've accounted for the water bill, we've accounted for general maintenance, trash, some of those expenses. I do have a complete Excel sheet breakdown of this. If somebody wants to see that, I can share that later. So we deducted all the expenses. We've also accounted for 5% vacancy, which is being conservative here. And then we arrive at the net income of 111,795.
Very good. Yes, it's always when we talk about numbers, people need to know. So basically, the gross rent minus all the operating expenses arrive to that. We did not consider anything that's mortgage related, right?
Yes,
Okay.
this number, the net income, does not take into account any mortgage. This is if let's say somebody were to pay in cash and buy this property, this is the net income they would be getting every year in their pocket.
Okay, now let's look at the next slide that Sushil prepared, right? Okay, with and without leverage.
Yeah, this is very interesting, and this is where a lot of people are like surprised to see the net tax equivalent yield at the end. But I'm going to go through this in detail. The purchase price is assuming we buy this at 1.5. It's listed at 1.59. We always want to go slightly under than the asking price. So assuming we buy this at 1.5, the first table is without leverage. You pay everything in cash, so your net operating income is 111,795. Now the second table.
Sushil, we lost you in the mid sentence.
What? Can you see me now?
Second table.
We can hear you again. We can hear you again, Sushil.
Okay. So the second table is pretty much a 30% down payment case. You come up with 30%. That's another thing we advise our client not to be over leveraged. We'll talk about that later. So let's say you do a 30% down payment here. You go to Kathy and say, Kathy, give me 70%. She'll run her numbers. She'll underwrite everything. And she will give you one of the best terms that we've seen in the city of Chicago. If you go through that route, your interest is around 40,920, almost 41,000 every year. Depreciation is same with or without leverage. The taxable income. Now here's the magic part. You might think this is only 10,151, but this is your taxable income, not your net income. When you remove depreciation from this case, the depreciation is for the IRS. In the eyes of IRS, you're making only 10,000, but in reality, you're still making the net income of 35,000 that you see there, just above the tax equivalent yield.
It should be the 40,920, right? The net income after interest. Oh, you say after the tax is 35. You're right.
Yes. So let's say you take that depreciation, you remove the interest part, your taxable income is only 10,000. This is just for the IRS. This is not your real income. For the IRS, this is the taxable income. But in your pocket, you're still getting $35,844 on an investment of $450,000. So look at the difference. On 1.5 million, you're making 71,000 without leverage, which works out to 4.75%. But if you take a leverage, your down payment is 450,000, and you're making 35,844, which straight away is almost 8%. Huge jump. So
8% tax equivalent yield. I don't think there are many things can.
No, we don't find
it can surpass that, right? Yeah.
Right. Yeah.
We have not even considered the appreciation in the future.
Absolutely. So if you look at the appreciation, we advise people to hold these properties for at least 10 years. You're easily going to make at least 2 to 2.5 times on your initial investment when you look at all the 10 years of income. And let's say you were to sell after 10 years at the same cap rate that you're buying now. So it's all there in our Excel sheet. We've developed an amazing model where we can forecast what your selling price could be and also what is your rental income from year 1 to year 10.
Okay, as an accountant, I'm going to test your knowledge, Sushil.
Sure. Mm-hmm.
Where did you come up with the depreciation number?
So the depreciation number is decided, the formula is decided by the IRS. This is a commercial property. Anything above 4 units becomes a commercial property. So they let you amortize the depreciation over 39 years. So we've taken 80% of the property value, which is the building value in the state of Illinois. That's the formula that's accepted. 80% of the property value gets depreciated over 39 years.
Yeah,
so
very good. I want to also point something here that I have, because we have clients all over the nation. So if you are from California, normally you were not going to enjoy such a high depreciation, phantom expense of depreciation, because normally the land is about 60, sometimes 70% of the value. So your structure is much less. So in Chicago, 80-20 is a pretty good rule of thumb. So it was 80% of the price can be depreciated. Sure, you can always go find appraisals to be aggressive. So that's also really important. You want to have depreciation on your tax return. Depreciation is your friend. I think our second or third webinar was talking about bonus depreciation. We're not even talking about bonus depreciation here, right? We're more focused on the interest here. So yeah, Sushil has a really, really good point. Basically, if these numbers, I verified. So I'm an accountant. I verify Sushil's numbers.
Oh, yes. Everything is going to pass through the IRS lens.
Yeah. We need a Kathy to verify 6.75 doable in this day.
Yes.
Okay.
It is with me.
So is 70% doable?
70% on this one, yes.
Yes. And this is a property your bank will leverage, right?
For sure. Yeah. So, our rate is right now at 6.75% for 3 years. And also, I'm not a tax expert, Justin, you are, but just, like looking at from a third party point of view. So like net income after tax and interest, we're looking at 35.8 net income. So if you initially had 1.5 million to invest in the real estate market with leverage, you investing like 450 only of your own money. So essentially you can basically you can buy 3 properties and the net income, the 35 can triple, right?
Yeah, you're gonna have 110, right?
Okay, sounds good.
Yeah, with the same, that's a really good point of view. Like with same 1.5, you're gonna make 110 instead of making 70, and that's really net income after tax. It's amazing, right?
After all the expenses, this is your net. No one's gonna touch this money.
Yeah. If anyone wants to question Sushil's numbers, you can always schedule a call with him later. But I think we're trying very hard to show you guys a real example, because I believe numbers tell the story better than I tell the story, right? And this is all real number, real property, everything. Okay.
So there are a couple of straightforward questions.
Can we go to the end or now?
Even or because I don't know, it's up to you guys. We save it to the end or we.
Let's do it at the end because we have a flow and we try to finish it on time. So because everyone only have a little bit lunch break, right?
Okay.
Thank you, though. Thank you.
Cap rate, yes, there's the same for both cases.
Yeah. Okay.
Right.
Yeah. Cap rate in this case is about I forgot. So is it 7 point?
Which is really good.
Yes. So the net cap rate you will get after mortgage interest, if you're calculating, it works around 9% in this case.
Okay.
Yeah.
So the cap rate, I think, considering
the purchase price considering 1.5, you're buying at 7.45.
Okay, 7.45 cap rate. Yeah.
Yeah.
All right. So there's one thing for sure: the cap rate still needs to be higher than the borrowing rate, right? Otherwise, the number will not work, right?
Yeah.
Everyone understand that.
And I'll just take 1 minute to talk about cap rate here. A lot of people have questions about cap rate. So basically, your net income divided by the purchase price is how we get the cap rate. So that is a term we use a lot in investment properties.
Yeah, yeah. And also, really, in investment property, people don't sell the price. They don't list the property, the price. They list the cap rate, right?
Yeah.
I think people are asking what's the difference between TEY and cap rate.
Oh, it's a completely different thing. So if you want me to talk about that, we might not finish on time. So it's a completely different. You see, the tax equivalent yield is how much actually the net income you have after you pay the tax, and divided by how much you put in. And the cap rate is a building's net, like this one, right? The net income is 111. The purchase price, let's say, is 1.5. You divide that is your cap rate, right?
Yeah.
So cap rate is very clear. There's no mortgage involved.
Right.
But the tax equivalent yield has a lot of consideration. You consider the interest expense and the tax expense. So it's completely different.
And also, I'd like to add, Justine, one more thing. The cap rate doesn't change depending on who's buying. The tax equivalent rate will depend on your case, your tax slab. So,
very good. Very good. We're assuming 50%. People might think Justine is crazy. I'm not crazy. So if you live in the city of Chicago, your highest rate possible is probably 45, but if you live in California, it's 55. So I picked the middle number.
Right.
That is what's the high income people are paying on the, because you have the 37 federal, you have the state, and you have the 3.8 net investment income rate, right? All these things adding up together, guys. It's a lot of tax. Okay. Always consider tax when you do investment. We will get to you with those answers, and then Sushil can answer your more questions. But I really would like to, at this moment, thank you, Sushil. This is really clear. I want to give it to Kathy to talk about how, as a local bank, you look at these properties. How do you make your decisions? I have people always come to me. I only make $200,000. How do I borrow $1 million? Who's gonna give that to me? So this is a common question. So I'm gonna give it to you, Kathy, to talk about how it's different when you underwrite a home loan or an investment property loan.
Yeah, sounds good. Yeah, that is the $1 million question. I hear that all the time as well. So very simple. When you buy your home, we focus on your personal income. When you buy the investment property, your personal income becomes a secondary factor for us to consider. The primary factor that we evaluate is the investment, the operating income from the investment property. Yep. So yep. So DT. So when we analyze a home loan, we look at what we call a DTI, or debt to income ratio. So basically, it's pretty self-explanatory. I'm pretty sure everyone here know about it. So your income is going to be your W-2 income, and if you're a sole proprietor, then the Schedule C income. But do know though, your Schedule C income, we do look for consistency. So for example, in 2021, your Schedule C income was $30,000. Then 2022, you were looking at $60,000 and you were doing the same type of business, then there's an inconsistency in there. So we will need to dig further, and maybe, I don't know, it depends on the situation, take an average or stick with a lower number. So please note that. And also, if you have
you guys discriminate self-employed people. I don't like that.
There has to be a reason, right? Yeah. We exercise a lot of common sense. If you go to Fannie Freddie, it's very, very strict when it comes to that.
I know.
And then going to then maybe if you own other investment properties under your own name, Schedule E, Part 1 is also something we look at to see how much rental income you will have. So that's the income side of the personal income. That, the property tax, the principal, interest, and insurance associated with the property that you are going to buy. If you own other properties, and the net operating income from those properties, and no, I'm sorry, so the debt from those properties, and also the monthly required payment for your credit cards, for example, your monthly auto loan payment. So all these things add together, that'll be the debt level that we, basically divide your debt to the income, and we look at the ratio to see whether you can afford to buy this house.
Right, because in a way, I want to chime in. In a way, Cassie agreed, home is a consumption.
Yes, for sure.
Yeah, it's a sometimes a very luxurious consumption. So I mean, you have to make enough money to support it, because when you don't make money, you don't pay the house, the bank will end up with the house, right?
Yeah.
But let's say investment is different. If I don't pay the bank, take that property, they make cash flow. Go ahead.
Properties, yeah. Well, yeah. So like what Justin said, investment property, very different. People will call me and say, "Oh, I don't have much income, but I want to buy this 5-unit. Can I even qualify?" Then I will answer, let me look at the cash flow of the building. And that's the main thing we look at. On your personal side, I mean, can you afford your, I don't know, living expenses? And they're like, yeah. Then I was like, well, then don't worry too much about that. Let's focus on the building first. So again, like when you buy investment property, what's the primary repayment source. That's you're going to use the rental income you get from the investment property to pay your mortgage every month, right? So that's what DSCR is, which is a debt service coverage ratio. Basically, we take the gross income, like Joe actually went over all these already. Gross rental income, we deduct all the operating expenses, like he said, the utility, the property tax, which is the biggest thing, management fees, for example, and we come with the net operating income. So that's the number we look at. That way, see whether this number can cover your monthly principal interest payment, and there's money left over for you to earn as an investor. So obviously, the higher the DSCR is, the better it is, the better investment it is to us, because that means your building's generating good cash. However, just because some buildings have high DSCR doesn't necessarily mean it's a good investment, because sometimes you have to work for that money, and sometimes why is that building so cheap? There might be a reason to it. There might be a pretty high vacancy rate in that area, and so always be careful, always rely on a real estate professional.
So let's go back to this one. So when you calculate the debt, debt, how you say that? Let's go back.
That DSCR, that service coverage ratio.
Coverage ratio, right? So your net operating income, let's go with Sushil number, it's 111. So, and your mortgage payment will be the 70,000 plus the principal, right?
The
principal
so we're looking at
pretty small, right?
Let me just see.
That's like, let's say it's 80,000. So I just want to show people the numbers.
Yeah,
so
it's exactly, Justine, it's exactly 81,723. Your first year monthly payment is 81,000.
81,000. So it's 111 divided by 81, right? Am I I think this way people understand what's a debt service coverage ratio. So you have a ratio of 1.37. Is that a good one?
That is a pretty good one for today's market, because interest rate is higher.
Okay, it's
really pandemic level, right? So
So what is your kind of threshold? When it's under what is bad?
Well, obviously, under break even is really bad.
Oh no, 100 is terrible. You cannot do 100. Yeah. So is it like 110 is your threshold?
No, we're the approval threshold for banks is higher, 1.3, because we want to make sure that you're just buying a building and betting on appreciation. You are actually making some money, right?
So in a way, do you guys see that the bank is a great partner for you? Why? Because the bank is underwriting this deal for you too. So if the bank approves your loan, that means it's a good investment, because the bank is. The joke is, Kathy, don't get offended. Bank only want to give money to people who have money, right?
Of course, we're business people. So
people who don't have money, you guys don't want to give them money. So bank is the cream on the top of your cake. Okay.
Yeah, exactly. But just so you know, the 1.3. But nowadays, with the higher interest rate, if people will like to borrow as much as possible, right? And with the higher interest rate, sometimes it just doesn't reach 1.3. And I think 1.2 is still really decent. However, we do have the approval threshold, so a lot of we're a risk management business, right? So a lot of factors come into play. So if it's below a 1.3, we need to look at your financial strengths as an individual.
Yeah. So just like the deal you're working with us right now, you might even be able to go to 80% LTV. So if people are listening, you can. When your DSCR is so beautiful, you can borrow more money to bring it down to a level that the bank accepts you. So hopefully this is like 101 lending. Thank you, Kathy, that people will understand when you buy an investment property, it's a completely different story. And you would want your bank to be there for you. They are doing the free underwriting for you, whether this building is good for you, right? So here comes, I never thought this is one good reason to have leverage, right? And the bank is not going to be, the bank doesn't get a commission. You know? They want to make sure you get, because they give you the money.
Yeah, believe me, when a loan goes south, it's extremely, extremely painful for a lender to deal with a problem loan. So we don't want that in our portfolio. And, we play very safe. And, once we approve, that means we're making a pretty good investment.
Yeah. I think we're very good. So DTI right now, just a side note, is about still 42, 40?
Yeah, 43%. If it has to go a little higher, I mean, it just, it's case by case, but it should be fine.
Yeah. Okay, very good. The only other thing I want to mention here is a lot of people might not know when you go into commercial lending, there's not really a fixed rate, right? It's normally a 3 or 5 year balloon
Correct.
or arm, right? So don't get like, oh, that's terrible. This is the risk you have to take, right? This is when you go.
I mean, again, it's the risk management by the lender too.
Yeah.
If we cannot give a very long-term interest rate like home loans, so that's a norm. 5-year balloon loans is a very normal thing. We can do something about a 10-year, but 5-year fixed for sure. 3 or 5-year fixed. And amortization wise, your home loan you're used to 15 to 30-year amortization, and for commercial loan it's usually 25. Yeah.
Thank you so much, Kathy. I learned something too.
Oh.
Okay, let's go to the next question, right? So this is the question I think I get asked every single day. Should we still invest in real estate? It's high interest rate. Should I just go buy the bond, right? It's the easy way. I have a lot of people. I've done maybe 50 returns this year so far. Everyone has a lot of interest income. They're very proud of themselves. Until I talk to them. I tell them no. So so I compiled something, but this is really a discussion. So Sushil, what's your take on it?
I hear the same thing when I'm talking to clients. Hey, I'm getting 5% in my bank. Why would I buy an investment property that's generating 7%? I tell them the 7% is after tax, after all the expenses. Do you know what is after tax on that 5%? And they're like, I don't know. I'm like, it's 50% going to the IRS from the 5%. If you're on the 50% tax bracket, the 5% is really 2.5%. And that's when they realize that the worst kind of investment, I don't even call it investment, is parking your funds in a CD thinking it's an investment. You can park it for some time till you find the right investment property, but that's not how you should be growing your money. It doesn't grow. Yeah.
How about Kathy? What's your opinion on should we still leverage in a high interest environment?
You should. I mean, you gave the example earlier, right? Obviously, you make more with leveraging.
But if your rate is 10%, we should not do it, right?
Right, exactly.
Right?
So
we should not do that. Yeah. So 6.75 is okay.
Right. I mean, people got spoiled during the pandemic with the low rate. Before the pandemic, we were at the same level of the rate as we are seeing right now. So, but before I entered banking or lending, I just like my parents, Chinese parents, they don't borrow. Okay. But now I know how to get rich. You have to leverage.
That's 101. Use other people's money, make your money, right?
Exactly.
Leverage. I mean, there's always a point you leverage too much. That's not good, but not leverage is definitely not an option. So here's what I come up with. Why it's a resounding yes, but you have to also be careful with the things. So first one, very important, the cap rate needs to be higher than the interest rate. When the cap rate is lower than the interest rate, I'm not saying don't buy it, but be cautious. Now you really have to look at every aspect of this deal. Maybe you can buy down the rate, right, Kathy? That's doable, right? There are other ways you can do it. But if like the one we showed you, it's clearly great debt service coverage ratio, then you don't have to worry about that. But when the cap rate is lower, you need to be very cautious because you might go in there and the interest is going to eat away all your profits. Okay. And guess what? The bank will not lend you anyways.
Or only lend you a little bit.
Maybe they lend you 30% instead of 70%. You're going to put in 7% of your own money. So the second thing I always tell people is when the rate is lower, you can refinance. We've been doing this for years. We had investors. Some of you probably also saw him. He's in a lot of my webinars. Paul purchased the building right by the Wrigley Field, and 2 years later the rate went down so much, so he refinanced and got some cash out to buy more investment property. So, and always look at this way. I tell people the price you pay is fixed. The interest rate you pay is not fixed, right? But it can also go up, right, Cassie? We don't know.
Exactly.
Well,
Otherwise, we'd be rich. We don't
so
know.
people
Yeah.
ask me this question. So how about if the interest rate go up? Then I'm upside down. Guess what? If the interest rate goes up, that means our inflation is going crazy, right? Otherwise, there will be no reason. Economics 101, right? And when
Right.
the inflation goes up, what does that tell you, Sushil?
Your rental income will go up. You have
Thank
a reason to
you.
increase your rents.
Yeah, so your rent is going to go up. So your cap rate is going to go up. So
Right.
everything is a moving pieces, right? So
Yes.
the only time this game will not work is your city becomes a city everyone leaves.
Exactly.
Nobody wants to live there for some reason. Maybe
Right.
it will sink into the ocean. I'm just kidding. I just read something about a city, a major city is sinking into the ocean. If that's the case, if people are leaving, then hey, we cannot be prepared for those kind of things, right? We're talking about a normal situation, right? So the next one is the cash on cash improves every year, just like Sushil said, right? Rent goes up, and hopefully rent goes up more than your property tax go up. So this is also a very, very touchy subject. I've actually met a couple of my real estate investors who have properties in Florida. It's been a really tough year for them. Property tax went up like 3 times. Insurance went up more than 80%. So these are really difficult times. I don't think the rent is going to go up that much in the short term, right?
Right.
So one thing I can say about Chicago is, I mean, our property tax is not low, but it's year over year, the rent has surpassed all these things from our experience. That's why I always said Midwest is a good place. The rental market is really, really strong. And the last one is, Sushil always says that was really good. Yeah, when interest goes down, the property price will increase, then your cap rate will go down too.
Yes, it's always people ask me, can I wait till the interest rates go down? I tell them when the interest rates start going down, the values of the property will start going up. That's again economics 101. They're always correlated, inversely correlated by that much number. So the main thing to look at is the cap rate. If that is higher than your mortgage rate, then that is a good investment property to buy. You should not wait.
Yeah, and also another very important thing is it's a stable neighborhood with stable rent prospect.
For sure.
That's really, really important. Yeah, because there are places give you 20% cap rate. Like Kathy said, do you want to invest there? Question mark, right? Why?
Do you want to have a heart attack?
Yep.
Yeah. As long as you know what's the risk you're walking into, you're totally fine. The worst is you don't know there's risk, right?
Right.
You're blind. Yeah. So hopefully everyone is on the boat with me, believing in leverage is even good during a high interest. The low interest, I don't think I need to convince anyone. They're all with me, right? So the next question I want to discuss is how much should you leverage? I want to open to the floor. What do you guys think?
How much should you leverage? I mean, that's a good. I mean, we've seen horror stories with investors. We don't. Thankfully, we're good with our risk management. We see people who over leverage. We see their high risk profile in that person. Ooh, so Shell just okay.
Susha has very unstable connection today.
Yeah. So how much should you? I mean, it really is about whether when we see your portfolio on your personal financial statement, we can see a lot about your investment risk profile. You have to invest in things that make sense. Otherwise, for example, if you have a whole bunch of office, downtown office nowadays, that's probably not good to us, right? Yeah, you're leveraged, but the property value has gone like this, right? So it depends on how much common sense you have as an investor.
Yeah. So I always feel this way, the balance is always the answer. And your own risk tolerance is another answer. There's no absolute numbers here, right? So if Kathy comes tell you you're such a beautiful borrower, you have such a beautiful property, I want to lend 80% to you. Doesn't mean you have to take the 80%, right? It can be 70%. The thing we're trying to say here is do not leverage, but also do not over leverage, because we all heard horror stories about over leverage. If I don't know, I lived through 2009, right? People will walk into 20 closings in 1 week, walk away with $10,000 cash in their pocket every closing. I mean, that's just not going to sustain, right? So over leverage is really bad. Sushil was going to say something. Mm-hmm.
Yeah, I mean, we always recommend 25 to 30% of down payment because based on our experience, we see that is a very comfortable number where you will not get in trouble of any kind if it comes to a scenario where one of your tenant leaves or the rents are not going up. The best thing is to come up with at least the minimum they say is 20%, but we are more comfortable with 25 to 30%.
Yeah.
Exactly. That's our for multifamily. We're looking at 75%, although we can lend up to 80%. Most
Yeah.
banks they do 75%, but we can go 80 for a pure residential. If it's a mixed use, for example, with the ground floor commercial, then we're capped at 75%.
Yes. I do have clients sometimes only borrow 50%. And so this is the story I tell most people. I have a doctor client. So we talk about emergency fund a lot, right? So most people say, what's an emergency fund? They always say, oh, I have 6 months emergency fund. That's enough. But that doctor told me he has to have 2 years money in the bank. Otherwise, he'll wake up in the middle of the night, right? When your risk tolerance is this low, you should put 50% down, right? So I don't want you to lose sleep. That's not good for your house, right? So again, there's a bank has underwriting and you have your own risk tolerance. So here we are telling you not to just borrow, and one day you bust. It's something, it's a personal preference. Another joke always is all the builders, right? When the building is finished, they go bankrupt. And the reasons because they leverage too much.
Exactly. So
the economic trend return, go ahead. Mm-hmm.
Yeah, so I was going to touch a little bit on construction loan or rehab loan as well. That's when we really need to look at how much you have in the bank because, when you're building a house or when you are renovating, doing the rehab of a multifamily, for example, you don't have any income from the property at that point. So we really need to make sure that you are able to afford to pay the bank during the construction phase. However, that's why banks like multifamily as well, because we have investors. Yeah, it is an older building. However, you can still have your tenants to live in other units while you renovate that one unit where the person just moved out. So it's like you always have the income stream to support the loan.
Yeah, multifamily in this way much better than single family. Yeah.
Mm-hmm.
Yeah, I know that.
Yeah, I get asked that a lot. Well, why should I not buy a single family? I give them the same example. Let's say your tenant leaves and you find another tenant after a month. For that 1 month, your rental income is zero. So in a multifamily, let's say it's a 6 unit, even if one tenant leaves, the vacancy is only on 1 unit, you're still getting income on the other 5 units.
Yes.
Yeah.
Yes. Okay. So the last thing I want to touch on, I think we're already over time. It's such a great time talking to you guys. I love these discussions, So I'm sure Cassie has other creative financing tools. For me, I just want to touch on 2 things. In the very beginning, that couple, I also convinced them because their biggest asset was their home. So they took home equity loan to buy investment properties, right? So in a way, they borrowed 100%. You guys follow me? They have $1 million home paid for, which a lot of us do. We pay off our mortgage like we are the hero, right? Especially after especially after 2018 tax reform, the interest is not really. You don't itemize anymore, right? But they did that. They borrowed that money and then borrowed the rest of the money. And they said, can I deduct that interest on my investment property, the tax schedule, which is Schedule E? Sure, you can. Because you borrowed that money to buy the investment, right? You didn't borrow the money to go to Hawaii to spend the money. So you can take home equity loan and buy investment property. Make sure to correct accounting. Don't move the money everywhere, right? You borrow the $500,000. Make sure go into a special account to fund your investment property. Totally deductible. So now you can seriously borrow 100%. Sure, you have to have very good income personally to afford that line of credit too, right?
Mm-hmm. For sure, yes.
Yeah. Another thing is you can use your solo 401k. You can borrow from your solo 401k. And people sometimes, don't know. A solo 401k get to enjoy all the 401k. Everyone can borrow from their 401k, right? But they never thought they can borrow from their solo 401k. So, you can set up an LLC for your business. And you can set up a solo 401k and you can roll over all your previous jobs 401k into this solo 401k and borrow from yourself. That money you can also use to buy investment property. There are a lot of ways you can, I'm not going to, these are the two just come to my mind as an accountant. I want to put it out there so people know. Maybe Kathy can give us some more creative financing tools.
Yeah, I was going to, number one, I mean, Justin, you're like the guru with tax vehicles. So I'm learning so much from you, and I will be reaching out on you regarding the solo 401k. But anyway, just from the lending perspective, as Justin mentioned, the home equity line of credit, obviously, it's not borrowing 100%. You put in money to return that loan to build up the equity of your house. So, that's definitely, the benefit of a line of credit is that you can draw the line up and pay it down. So line credit is available for to you for us is 7 years basically. So if we give you say a $500,000 line credit, when you need to buy that home and you need an extra 200,000 for your down payment, you dry it up, right? Then once you make a nice profit from investment property that you sell, you have the extra money, you can pay down the line of credit. Then you want to buy another investment property, you can draw the line up again. So when you pay it down to like 0 or something, you don't pay interest while the line of credit is at 0.
You basically have a checkbook, right?
Yeah, exactly. Yeah,
a nice checkbook. Yeah,
exactly. So that's my investors, especially the Chinatown area investors. They love line of credits because there are so many cash offers on good investment properties, and they want the line of credit available for them to draw. So equity in property is definitely important. And also you can do cash out on your investment properties when you have, when you have enough equity. No banks, I don't think banks will want to take a second position on investment properties. However, if you only have a little bit of a loan, or if you have a loan that's what we call free and clear, that doesn't have any loan, just a property, you can always just say, hey, here's my property, I'll pledge it to you as a collateral, give me cash so I can make other investments. So we can do that in both a amortized loan, or we can do that in a line of credit, a short-term line of credit as well for you to make other investments. I just want to share very quickly, I think it's a very good example of what we talked about today. It's just a very real case, a phone call that was someone called me 2 days ago. So basically this guy, he lives in a $800,000 home, right? There's $1 million dollar home is his neighbors. He had been eyeing that home forever. That's his dream home. So neighbor wants to sell. So normally, right, you will sell your own home in the morning, then you buy that home in the afternoon. Right? But that neighbor has to leave the country due to a family emergency. So he's like, okay, I don't have a lot of personal income, and I really want a house. I've been looking at it for like 5 years, So he's like, can I do a home equity line of credit from my own home and buy that property? So I was like, well, when you say you don't have a lot of income, that is a little bit tricky because, again, your personal home, we look at your personal income, right? Yeah, exactly. And if you're not selling your personal home, I don't know how long it's going to take for you to sell your personal home, right? So I basically have to underwrite based on 2 mortgages, your own personal home mortgage and this new home or line credit, those obligations. Then he tells me I actually have free and clear multifamily properties under LLC. Let's forget strategy number 1, which we cannot underwrite again. As I mentioned before, the income of your multifamily properties, we're familiar with the area. I know he makes good money. We can use that to do a cash out to get him to buy a dream home.
Yeah, so I sometimes feel Kathy's job is also you just have to know everything about that person to really give them the best advice. It's almost like me. People always call me saying, hey, give me all the tax strategies possible. Nothing, because I don't know who you are. Like I gotta know your situation to give you solutions, right?
Exactly. Knowing the customer is very important.
It is the first thing. I think we're running out of time, so we cannot take a lot of questions, but good discussions, guys. Let's look at it. Here's our what's called rap sheet. If anyone has questions for loans, Kathy, and I think we do have a 15-minute thing coming out for Sushil for people to schedule, right? Christy. Okay, thank you so much. Yeah, Sushil is a real estate investment advisor that understands tax. I make sure of that. He really understands the tax. Yeah. So I think this is whoever you guys want to do the social media thing. I'm not on any of the social media, but my company apparently is. Let's do Q&A. We have 10 minutes, 9 minutes. Let's do this. Okay. Not sure understanding this question. Do you guys understand that question?
Real estate
Leverage, I think they want to know what the term leverage. Leverage, pretty much in simple words, is taking a bank finance, going to the bank and saying, give me money to buy the real estate. That's just pretty much in simple words, leverage.
Yeah.
Not using 100%.
What kind of loan is what? It's mortgage, right? Is it called mortgage? I
Yes.
don't know.
So when you do a personal home, normally people call it mortgage, but in an investment property, we just loosely use the term leverage, meaning bank finance.
Okay, sorry. And if you have more questions, you can always reach out to me. Mm-hmm.
The cash flow seems to be 500 is just suitable for investment instead of required. Huh?
I don't see 500.
So if you have 1.5 million, we just did that 450. So you can, like Kathy said, you can buy 3. If you buy 3, you're gonna have $1,500 cash flow, right?
No, in this case, the net cash flow before you pay taxes. So cash flow is something that is in your hand after all the expenses, right? The interest, the mortgage, and all the expenses. It's coming to $30,000. If you want, I can, like I said, share the Excel sheet where we have all the calculations. So it's not just 500.
Okay.
Yeah.
So there's a misunderstanding here. So Shil is gonna tell you. Next one.
Down to online investment property.
We do, yeah. So Sam, there's a way you can do. A lot of people, young people, do called the house hacking. So they buy a multifamily and they live in one of the units for at least a year, right? So they can qualify for the primary home, and that's, I think, is 5%. And then you can move out and then rent it a whole out. I think that's not lying, right, Kathy? You at least live there for a whole year. That's, you don't just not live there at all, but you are limited to 4 units. When you go over 4 units, it will be considered as a commercial. A lot of young people are doing that.
Yeah, I mean, I even looked into it when I was buying my place. Basically, yeah, a lot of people, it's a good investment trust strategy. Your renters pay your mortgage.
Yeah, you basically renters pay your mortgage. Very good, Sam. Hopefully this helps. And then the next time you can buy 20% investment property with the 20%.
There we go.
Borrowing from your 401k. I'm just kidding. Go on, next one.
What property target savings can they?
Yeah, I said if you have a solo 401k, you have a 401k, but it's limited. You can only borrow so much, but yes, you can borrow. Mm-hmm.
If it's this long down payment,
you can borrow from your 401k, yeah. Mm-hmm.
Payment percentage requirement change if it's
okay. Kathy, question.
No, we don't. I mean, people, when you buy investment property, most likely, Justin, correct me if I'm wrong, but I'm seeing a lot of LLCs, what we call real estate holding companies. So it limits your liability. So no, it doesn't really matter. The down payment percentage is the same because we look at the property.
Okay. Yeah, and if you buy it with your personal name, it's not advisable, right? You should do LLC for liability protection. Byron?
How do you determine vacancy rate in a market? Again, that's where.
Very good question, Chris. This is a very local question. You definitely have a national average, but local market is important. Maybe Jill can answer your question.
Yeah, the local average based on past trends, we pick up 2-3 years of data for individual properties, individual location, individual neighborhoods. And we've seen it, you can safely assume 5% vacancy. Sometimes it's not even 5%. You have 6 tenants renewing back to back for a couple of years. But just for calculation's sake, to be very safe, we assume 5%.
Yeah, I mean, like the area that Social shared for his case example, I wouldn't even worry about the 5%.
Yeah, yes. I mean, we have a PM arm. My company has a property management arm, and we manage close to 150 doors now. and our vacancy rate in the Chicago market is, I would say, less than 2%.
Yeah.
Yeah.
You get 60 days.
You need a good PM. You need a good PM. Yeah.
Right, and you get 60 days notice when the tenant is leaving. So in those 60 days, you can definitely find a good tenant if your neighborhood is a very aspiring neighborhood. So that's not a problem.
Yeah. Go back to you have to buy in the right place. Yes.
Right.
Next one, maybe just one more.
Yes, we do. I touched on that. Rental properties love it, and yeah, we can get you cash out.
Okay, make sure reach out to Cassie, Christine. Maybe one more. No more. Okay, that's good. Thank you guys so much. Most of you know who I am. I'm very, very busy with tax right now, but you can email me your question. If I can help you, I will help you. You all know I always do. And due to the busy tax season, our next webinar will be in May. Sorry about that. Meanwhile, I guess happy tax season to me. And thank you, Kathy, and thank you, Sushil, for your time.
Thank you both very much.
Yeah, and everyone will get the recording after 24 hours, right, Christy?
Around that, yeah.
Around that. Okay.
Thank you so much. YouTube channel. All right. Hang in there, Justin.
Bye-bye, everyone.
Bye-bye. All right.